I'll now hand over to Ian Sim, who is the founder as well as the chief executive. He founded the company Impax in 1998, and it's been going from strength to strength ever since. And particularly these last few years, it's accelerated in its performance. So I'll hand over now to Ian, if I may, and Charlie.
So hello, everybody. I think that's a key for me to take over. Thank you, Cliff. So I'm going to take you through the slide deck, which reflects our interim results, so the first half of our financial year ending 31st of March. And in that time period, we really had an excellent period, and the summary is shown on the next slide. So, I'm supposed to give you an overview of the company first, so apologies. What is it that we do? Well, we are an investment management business, and what we do is manage money for pension funds and private banks, and that money is directed towards a particular investment idea, and our investment idea is based on our view of the future, and our view of the future is that there will be an accelerating transition to a more sustainable economy. What do we mean by that? Well, as more and more people crowd onto a finite planet, then there's going to be increasing pressure on environmental and natural resources, and that's going to lead to business opportunities to improve the efficiency with which resources are used, and given regulatory developments, for example, to improve the situation on pollution, to reduce climate change, to improve water quality, etc., there'll be enormous opportunities to provide the goods and services to clean up the environment. Now, 20 years ago, when I first started the business, that was quite a small area to invest in, but what we've done by sticking to our core idea is tapped into a rising groundswell of interest and actually quite significant scale and growth of this idea that the transition to a more sustainable economy is big business, and it's going to be a great place for investors to deploy capital. So over the last couple of decades, we've obviously built a couple of decades of experience. We've assembled one of the world's largest investment teams in this area, and with our combination of sort of deep science and engineering expertise plus knowledge about how industrial companies and utilities and regulators work, given the staff that we've hired, we're able really to dive into the drivers of value and understand growth in a way that the average investor probably is not quite getting, and that allows us to buy and sell companies when they're appropriately attractive. So buy cheap and sell when the company's looking expensive. So that's the core idea. We intend to stick to that investment idea. We think it's got enormous potential over the next couple of decades, and in an increasingly crowded world of generic investment management, then Impax really stands out as being a very special boutique with a particular idea that asset owners and potential clients can latch onto very quickly. So on the next slide is a summary of our investment capabilities. So we manage money in 4 areas. On the top, you can see our thematic areas around environmental markets, which is this idea of improving the environment, and the sustainability lens funds that we run are more broad-based global equity and fixed income products, capturing upside from companies that are advancing the sustainable economy in other areas than just the environment. So, for example, around healthcare and around financial inclusion. The gender lens is a specific type of business investment that we make, backing companies run by women, where boards of directors have got very significant female representation and senior management teams as well. And then more recently, we've developed our sustainable infrastructure product range as well. Where do we sell our services? Well, the business really is very broadly based internationally. So we have our own direct sales teams in the UK and the US. And in addition, we've got distribution partnerships, which allow us to prospect for clients in the rest of continental Europe, around Canada, Australia, and the wider Asia Pacific region. So we do have a fully international business with large sales teams in the US and a sales team, of course, in the UK as well. On the next slide, this is a summary of the first half year. So in that 6-month period, then we increased our assets under management by almost 50% to a record high of £30 billion. The increase was driven by a record for us level of net inflows of new money hitting the firm for funds under management, so £6.8 billion of new money. We completed the 3-year earnout period for the acquisition that we made in the United States, and we really established further strength and resilience in the platform for further expansion. That translated, of course, into some quite attractive financial returns. So we saw an increase relative to previous periods in revenue and profits. And crucially, as you can see in the bottom right of this slide, we announced a doubling of the interim dividend to 3.6 pence per share. So our business model in the context of running funds in this area of the sustainable economy is to scale up on those funds to sell the same strategy through different packages, different funds and accounts packages to client groups around the world. And by doing that, we can minimize the amount of product development and product operations, and the scaling that comes from that business model allows us, in theory, to be able to ramp up our dividend over time. Core financial objective for the business. On the next slide, you can see a little bit more about the context of our work and our positioning. So essentially the arrival of the Biden administration in the United States, coupled with further positive analysis and policy programs from China and its new 5-year plan, and further development in the European Union around its Green Deal, coupled with the Build Back Better programs coming out of the COVID crisis, has meant that there's almost never been a better time for market signals that money will be flowing into the sustainable economy. In that context, the number of companies that are producing exciting business plans in this area is growing rapidly. So companies that are offering renewable energy, energy efficiency, water supply and treatment, recycling and smart materials, sustainable food with healthy living as sort of core value proposition. And then in the broader sustainability lens areas, of course, companies offering fintech and personalized healthcare. These markets, as many of you will know, are growing rapidly. And so Impax portfolios are taking an aggregate view of this opportunity. These trends have not gone unnoticed by asset owners around the world, and there's been a real uptick in interest from pension funds, private banks, and other saver related institutions around the world. And that, of course, is great news for Impax in prospecting for new clients. And of course, the fact that we've got an authentic brand in this area and more than 20 years of track record, a investment and broader management team that's fully aligned with shareholders. So the management team collectively, including the investment team, own just over 20% of our business. And that means that we're well set for an alignment of interest into the future. The next slide, a little bit of comment about our recent progress. So we've got quite a successful partnership with St James's Place in the UK for distribution of our product range to the private wealth market. We've also been able to expand our UCITS fund range, targeting the broader European client base with an open-ended fund structure that's now exceeded £1.5 billion. Continental Europe is our core market in terms of the percentage of assets under management, and we've been particularly successful in Scandinavia in the last 6 months. And meanwhile, in the Asia Pacific region, we, with our partner BNP Paribas, secured a big new mandate from Nomura that's now over £1 billion under management, grown from zero in less than 9 months. And we've also established a new partnership with a powerful distributor in the Australia Pacific region. Finally, North America has been a core target market for our growth, and as well as having more success with the Pax World Fund range, then we've also been able to expand our institutional and third-party business, not just in the US, but also in Canada. Of course, at the heart of any successful investment management business is investment performance, and I'm very pleased to say that the performance numbers from our environmental markets range of 6 investment strategies has continued to do well. So these numbers in the bold font can be compared to the MSCI All Country World Index at the bottom, which is the generic comparative benchmark, and really show a successful period. And then on the next slide, the comparable data for our sustainability lens strategies is shown here. So our award-winning global opportunity strategy, which is behind the St. James's Place product, has done very well over 3 and 5 years. In the 6 months to the end of March, it did have a little bit of headwind given the rotation to value stocks that the market was demonstrating, but it's certainly seen no slowdown in interest from clients. And we had very good performance, particularly from our US US large cap fund, while the fixed income funds did well too. On the next slide, you can see the breakdown of our assets. First of all, by the investment strategy that is shown on the left. So the key message from that left-hand donut is that we've nicely diversified across a wide range of different types of product. This is not a single investment product firm by any means. And on the right, you can see the diversification by client type, with a good spread between distribution partner led business, for example, from BNP Paribas Asset Management, which represents about 33% of our revenues in the 5 funds that we sub-manage for them, and also our direct sales and segregated account business. On the next slide, you can see how the flows for the period stacked up. So on the left, there's the UK and Ireland flows, with the St. James's Place mandate there as the standout largest contributor. The BNP Paribas success was shown in the middle, and those 5 funds have all been performing well, with the Global Environment Fund, which wraps our leader strategy, being particularly successful given that that's where the Nomura money was directed. And then on the right, you can see some nice contribution from other parts of the world, with North America standing out, and a particularly strong year strong half year from the Pax World funds. On the next slide, we've continued to invest in the real assets of Impax, which of course is our people. And in spite of the challenges of COVID, we've been able to run a seamless, robust and resilient organization, with initially everybody working from home. And I'm very pleased to say that we've doubled the size of the business between March 2020 and March 2021, in spite of the challenges of COVID. We have been adding quite significantly to our staff headcount in order to cope with a rapidly increasing volume of new business. And that's basically meant that we've had quite an intense recruitment process, which is still ongoing actually. And by the end of this financial year in September, we'll probably have increased our headcount by something like 30 to 33% relative to the starting point at the start of the financial year. We've also launched our Dublin office. This was a very deliberate strategic move in the wake of the Brexit changes. And rather than having a token presence in the European Union, we've decided to have a material office and quite substantial client service and systems and sort of back and middle office capabilities. So we've now got 7 people in Dublin, and that number is likely to increase. In terms of systems, then during the period, we've strengthened our trading. We've created a global trading desk with the Pax acquisition trading team now fully integrated into our own global trading team. We've invested further in the resilience around IT, and we've paid particular focus to strengthening compliance and risk, which of course is right at the heart of a successful financial services business these days. On the next slide, then, of course, you can see our plan for growth in a nutshell. So the plan the business idea that I mentioned earlier around organic scalable growth really is founded in the fact that the capacity of the strategies that we're currently running is quite considerable. So that means that we can take quite a bit more money within the current suite of products, funds and accounts without the need for new products. So that allows us to ramp up the return on investment, if you like, and that should add considerably to our ability to increase our margin, as Charlie will explain. Having said that, we are not sitting tight. We are selectively investing in the development of new products. So we seeded and launched a Asian version of our global opportunity strategy back in January, and we're nurturing a couple of other ideas with a view to expanding the product range, including in the area of sustainable infrastructure. And then finally, in another part of our business, we're still running a very successful private markets operation, private equity investing in the infrastructure sector, backing the developers and builders of wind, solar, hydro, and other renewable energy assets. So we're coming up to the end of the investment period for our third fund in this space, and are working to raise new capital in this area. So I'm handing over to Charlie now.
Good afternoon all. So it's my pleasure to take you through the financial numbers for the first half of the year. So we can turn to the first slide, please. So here we set out revenue, and the great story that's coming through strongly in these numbers is the scalability of the business, i.e. how revenue growth is impressive in its own right, but significantly outstrips costs. So what we can see here is that revenue is up 31% compared to the second half of last year. Impax doesn't have a calendar seasonality to it in terms of its income or costs, and so the second half of last year is the most appropriate comparator, the most recent up-to-date comparator. So that 31% increase we're obviously very pleased about. In particular, that is driven by the net new money that's come through in inflows during the period. We can also see on here the nicely diversified revenue base by geographical location, and also on the bottom right that through our different classes of products, so the different groupings of equities, fixed income, private markets, the revenue margins are very stable, and any fluctuations you see are purely due to the mix of more inflows into one product than another, for example. So if we then move on to what this means for the costs and profitability, the left side shows the cost base split into three main components, and I'll talk to each. Firstly, we've got the non-staff costs, and these are under control. They've edged up slightly over the period as we've invested in things like IT, advisors' fees, etc. We should note that there's very little in the way of travel costs in this period, so that's likely to resume at a modest level at some point, hopefully later this year. But we don't see a need for any sort of systematic rebasing upwards of those fixed costs due to having a very strong infrastructure already in place, but it will edge up as the business grows. The middle bar represents the fixed staff costs, so this is salaries and sort of health insurance and other standard benefits. That's increased for the reason that Ian's mentioned, that we are hiring quite strongly. It's only gone up a small amount in this period, partly due to people joining intra-period, so there's only maybe a few months for those people, and secondly, there were a number of vacancies at the end of March, so that is expected to continue to rise modestly. And the final bar is the variable staff costs, so this reflects bonuses and the cost of staff equity awards, which have been a very successful way of aligning interests with staff, whereby all of the costs relating to those come out of a bonus pool, plus any national insurance, where that bonus pool is determined as a formula. We take the operating profit before that cost, so put simply the revenue less the first two costs, the non-staff and fixed staff costs, and then we take 45% of that number, and that creates the light blue that you can see here. So profits have run up, and that's the reason why that component has gone up. When you add those together, the total costs have gone up 18%, So contrast that with, you may remember I mentioned 31% on the revenue, and you get a feel for the scalability I'm trying to illustrate. Then what that means for profit is that the profits are actually up 62% versus the second half of last year, which I'm really delighted with that result, especially because you can see on the right that the operating margin has marched up strongly and to something like 34% for the period, and more like 35% on a run rate basis at the end of March. There's no reason why that cannot continue. So to the extent that we have the right market conditions and positive flows, then I would continue to see the same trend of revenues growing faster than operating expenses, and that margin continuing to rise through the 30s. So we can move on and just give a little bit more detail around that cost increase breakdown. Staff clearly is the main component. You see here the increase in staff of 10%. The bottom left is interesting. You can see here the fixed staff costs per employee has actually gone down in the period, and that's in spite of making annual pay rises in January. So the reason that's gone down is because for the most part we've got the senior staff in place, the overall all of the different departments and function heads in place. So the vast majority of hires are happening at the middle and junior levels, and hence they come in at lower salaries, and that's the proof of the pudding. You can see the average has actually trended downwards in the period. Importantly, on the right, Impax at its heart is an investment firm, and the key ability to scale this business is dependent on being able to invest more and more for clients without needing to change the investment capability. And we can see that strongly on the right, whereby the investment team has edged up, but only by 7%, so the lowest percentage I've quoted today. And yet the assets under management per investment staff member has grown a very, very impressive 39% over the period. So that really does, in a nutshell, demonstrate the scalability of our product. What this means for earnings on the next slide is that on the left we can see earnings per share has gone up strongly. This is due quite simply to the after-tax increase in profit. And as Ian's already mentioned, on the back of these strong results and the continued growth momentum, the board's decided to announce a doubling of the interim profit. We're 3 times covered for the first half based upon that 3.6 pence. So that plus the current momentum really does position us well for a final dividend at the end of the year. Just as a reminder, our policy is to pay between 55 and 80% of the adjusted profits after tax dividend. We very much continue to stick with that policy. At the moment, we're at the lower end of that range. So over time, there's every opportunity to see that percentage increase over time. But at this stage, we're towards the lower end of that range. Moving on now to the balance sheet. So the balance sheet is very strong. There's no debt. The balance sheet basically comprises cash, which I'll comment on in a moment, seed investments, where we invest alongside investors or to create new capabilities that we can then sell to clients. So we invest in what's called seed investments in our own products, relatively modest amount, but that sits on the balance sheet. And then we also have standard working capital. And finally, we have intangible assets where we've made acquisitions in the past. So the most interesting item is the cash, which I show here on the left. Now, cash actually is cyclical for Impax, and the reason for that is that we have our biggest cash flows in the first half of the year. You can see on here the final dividend being paid, and also we pay out the year-end bonuses in December, so that's part of the cash from operations. And as a result, we get a cyclical low at March and then tend to rebuild over the second half of the year. As you can see, it's not down by very much, frankly, over September due to the very strong cash generation in the period. So very happy with that 34.5 million cash, which on the right we illustrate what that means. And if we deduct a risk buffer, which we need to do for responsible management purposes, being a financially regulated company. And then secondly, if we earmark the interim dividend that we've announced, there's about 10 million of unallocated or war chest money that we can use for various purposes, such as for further seed investments or business or development opportunities, etc. So that's the balance sheet. And if we move on to the final financial slide, which is the shareholder register, the reason we show this on the left is just to demystify what sometimes can be puzzling when you see different numbers being quoted for the number of shares in issue. And the reason for this relates to the various share schemes that we've referred to that we have for staff. And what we do here is that when we make awards to staff, we have two ways of sourcing the shares. The first is that we can buy shares in the market, and that's what we've done a lot to date, where we bought shares into an employee benefit trust or EBT, and they sit there until it's time to give them out to staff. The second is that we can issue new shares, and we have got both tools available. We've used both in the past, and we'll do whatever we think is the best in shareholders' interest, depending upon availability of cash, pricing, and other potential uses of cash, etc. So we bought back shares that are sitting in a trust. They're not in treasury. They have not been cancelled. They're sitting in a trust. And on the flip side, we have 6 million of unexercised awards at this point. So there is a net dilutive effect of about 2 million at the end of March. So hopefully that helps understand what's going on. And then finally, in terms of the ownership structure, Ian's mentioned the 21% employee ownership. We also see on here 14% held by our major distribution partner BNP and a 65% free float. So I'll hand back to Ian.
So just on the final slide, then here's a summary. So what hopefully you've picked up, if this is the first time you've heard about Impax, is that we are in a really exciting place in a rapidly growing market. The idea that the transition to a more sustainable economy is going to lead to rapid market growth and great opportunities for well-positioned companies, I think, is becoming more and more well understood. And in that context, the fact that Impax has over 20 years of looking for such opportunities, backing companies, managing portfolios according to sensible risk parameters, and delivering great investment returns for sophisticated clients puts us in an excellent position to be a success over the medium to long term. We have a well-established, sizable team now, a very strong culture, and strong alignment between staff and shareholders. We have a powerful and diversified distribution arrangement with direct sales in some key countries, and then a network of third-party distribution arrangements in other countries and other parts of the world. And we are determined to translate our opportunity into a scalable business based on the idea of rising operating margin and a rising potential for dividends. So in that context, we do think that the firm's well placed for further growth, and the organic base growth model is well established and well understood. So I think that's a good place to pause and hand back to Cliff and Amanda for questions.
Well, thank you very much, Ian and Charlie, for that very clear and lucid presentation. Yeah, we've got quite a few questions come in. So there's a couple on competition, actually. And who are your competition? Other asset managers are playing catch up. Is there an asset manager, perhaps one that specializes in ESG, that you regard as real competition? So could be. Well,
I think from the perspective of the thematic or environmental markets funds that we run, then the competition's relatively thin on the ground. There are not that many teams globally that have got the capability to run products in this area. The ones that stand out internationally, I think, would probably be Pictet and Nordea, and they've got competitive strength and track record of winning institutional business. Obviously, in the UK, Lion Trust does have a team in this area as part of the Lion Trust business. In the sustainability lens area, then there's more competition in the sense that these are typically pitching for global equity and fixed income mandates, for which generic investors can potentially pitch. The competition for mandates that are oriented towards the sustainable economy will come from areas like, or companies like Wellington or Baillie Gifford. And so I would say that there's there's sort of more potential for competitive threat in that area. Having said that, I do think that our investment process does stand out as being quite different to how most, if not all, other global equity managers, the ones that we've seen anyway, approach the idea, so that when the investment consultant and investment manager community really delves into the details, then we do stand out as being quite different.
And I see quite a lot of the big fund managers sort of talking about this area of ESG. Could you outline how your investment process differs from those?
Yes, I mean, the label ESG is a bit of a slippery one. It's not particularly well defined, and I have to say that most investment managers who are marketing ESG funds essentially are providing another risk overlay onto their what they were doing anyway. So perhaps taking out a few securities on grounds of heightened perceived risk from environmental or social or possibly governance factors. Impax's approach is really completely different. We start from the premise that the world economy is being reprogrammed in the direction of more sustainable development, and that's going to underpin revolutions in areas such as energy, transportation, resource efficiency, etc. And in that context, we have created a way of looking at the 60,000 or so corporations that are listed around the world and filtering them for their attractiveness relative to those trends. So this is sort of opportunity rather than risk led, and does produce the start of our investment process, which continues through quite traditional bottom-up stock picking, looking for growth at a reasonable price. We're running investment portfolios of between 40 and 50 names, so quite concentrated. Our funds typically have active share relative to a generic index of more than 90%. In fact, our thematic funds have got 99% active share, which means that there's almost no overlap between our funds and a generic index like the Morgan Stanley or MSCI or Country World Index.
And there's a question about the soft closed specialist fund. Why have you closed this when so many companies are now providing services and technologies for the transition?
So the specialist strategy is the name that we give to the environmental markets strategy that covers the smaller companies. So I showed a slide with the 6 environmental markets products, of which specialist was one. Specialists is focused on small companies, which therefore have a limited ability to absorb investor capital. One of the strengths of our offering is that we're very clear and transparent to our clients and potential clients that will not take more money than we can credibly manage given these liquidity constraints. And so the idea of soft closing is to say to potential new clients in specialists, I'm sorry, but you can't come in anymore. The soft close label does mean that existing clients are welcome to top up, but essentially that's a signal that we can't manage much more money in that one particular strategy. Now, the other 13 or so strategies that we run are not soft closed, and therefore do have quite considerable capacity in aggregate for further inflows.
Yeah. Okay.
I think, sorry, there's just one, there's an additional point that came in the question, which is the situation going to change given the number of companies that are now working on these new industries around clean energy and clean transportation? And I think it's a good point. We are constantly seeing new companies that are eligible for specialists, and it's not out of the question that we would reopen specialists in time if underlying number of opportunities and liquidity improve.
Thank you. And what about private equity? You mentioned it in your explanation, but what are the plans for adding additional private equity in maturing businesses that are solving transition challenges?
Well, 15 years ago or so, we did have a period when we invested in later stage private companies that were claiming that they were going to go public within a year or so. I have to say that's a particularly challenging area to invest in. It requires a skill set which is quite different to the infrastructure investment skills and the listed market skills that we're currently using. And so, although we haven't closed the window to investing late stage development capital at some stage in the future, to do so credibly at any sort of scale would involve us bringing in a new team. So that's definitely not on the front burner right now.
Okay. And do you always see yourself, do you see yourself moving from being a boutique at any stage, or?
No, we don't. No, we do believe that there is a lot of mileage left in our boutique-oriented idea, which is that by specializing in this single investment philosophy, we'll be able to attract a lot more business. And I think that's probably a good definition of a boutique. So there are many generic fund managers who are trying to solve client problems in lots of different areas, and I think the typical generic boutique or generic fund manager is really struggling to differentiate themselves. So we're not aspiring to get into that category.
And one for Charlie, I think, is where does IEM sit in the AUM donut, please? Can you just explain what IEM is as well? And you're on mute, Charlie.
Sorry. Yes, IEM stands for Impax Environmental Markets, and it's our UK investment trust. And it sits within the specialist strategy. It's actually the same one that Ian's just been talking about.
Thank you. And we've got about 2% of assets are in bonds. Is there more fixed interest assets beyond this? And if so, what is it, please?
So up until 2018, when we bought Pax World Management in the United States, we didn't have any fixed income investment management capabilities. So we inherited those capabilities through that acquisition, and that was one of the central reasons for making the acquisition was getting into or tapping into that type of expertise. So although that area has grown since we bought the business, it's not grown in percentage terms. So that's it. We're currently running just 2% or so of our assets under management in fixed income. We do believe that there's plenty more to go for in that area, and we have mentioned in other fora, particularly our sort of half-year analyst call, that if at some stage the right acquisition opportunity arises in fixed income or in private markets, that we would certainly take a close look.
Yeah. And what is the split at the moment between fixed interest and equity?
So listed equity is over 95% of our assets under management, with the rest being fixed income and private markets.
And there's a good question, which I think we're all struggling with. We've heard a lot about ESG, and Douglas Battersby has asked, is there a danger of an ESG bubble?
Well, one of the benefits of ESG being a somewhat amorphous or slippery concept is it doesn't have a robust definition, and therefore the money that's purportedly looking for exposure to opportunities linked to, if you like, positive ESG factors is quite often directed in different areas. So I think a narrower restatement of the question is there a bubble potentially in some areas in which Impax is investing? And I think it's fair to say that in certain concept areas around the clean energy transition, for example, the hydrogen economy or electric vehicles, there have been periods in the last 12, 18 months when certain groups of stocks have been irrationally priced, overvalued by most conventional metrics. Impax's growth at a reasonable price investment mantra has really ensured that we've navigated around and avoided those bubbles and found opportunities in less frothy areas. For example, companies making pumps for moving fluids around, valves, actuators, sensors. These are, for many people, quite pedestrian products that perhaps are a little bit difficult in some cases to understand, and yet face huge growth markets because they're central to this idea of a replumbing of the economy in the direction of low carbon and resource efficiency. So yes, we do have to be careful about about bubbles and exuberance in our area, but we've never had a period in nearly a quarter of a century in which all the areas in which we're able to invest rise to eye-watering valuation levels at the same time.
I was very impressed with the performance figures which you put up, both the 1 year and the 5 year ones. Could you tell us about the lag between the performance figures and the growth in assets under management? Because there must be some relationship about being able to go out there and market your performance to getting additional funds.
Well, the growth in assets under management in terms of inflows really is a function of as much market sentiment and general confidence and optimism about the future of the economy and future of sort of financial market success as it is about the underlying products or markets. So the last 5 years have been pretty good for equity markets in particular, given quantitative easing and a general sort of final soft landing after the financial crisis. The policy trends around the sustainable economy have been ratcheting up and getting more exciting over the last 5 years as well, really since the Paris Climate Agreement in the end of 2015. So we've seen a steady increase in the noise coming from the drumbeat of policy around Biden administration's plans, China 5-year plan that I was mentioning earlier in the presentation. Our investment performance does count against that backdrop, and so what we tend to find is that the sophisticated clients that we're pitching to are looking much more at the longer term trends, 3-year, 5-year, and even sort of 10-year numbers than they are at the last 1 year. In fact, if the last 1 year last 12 months has been very good, they will ask questions about valuation and whether there's been a run up. So we're able to reassure them that at the moment that underlying earnings growth of the companies we're investing in has more than kept pace with the stock market performance. So that's a very long answer, but I don't think it's appropriate to be translating recent 1 year performance strength into a sudden acceleration of flows. But I would also point out the fact that the climate change conference in November, so-called COP26 conference, is likely to be a central guiding light for policy announcements, corporate announcements around climate type policies and opportunities for the next 5 or 6 months or so. And so we're expecting there to be quite a rosy period for interest in this space, at least at the end of the year.
Yes, that's the answer suggesting there's going to be a growth in people's putting assets into this area, increased asset allocation to this area, and with your track record, you're well positioned. And I was interested to hear you stress that the long-term performance is often what is actually more attractive to your customers.
Yes, indeed. Yeah.
Sounds a very strong position to be working from. I noticed the margins last year reduced from 52 basis points to 48. Is this a trend, or do we think we can maintain that level?
So I'll comment on that. The margin on an average basis has fallen, but that's due to asset mix. The slide I showed during the presentation showing the revenue margin per individual type of business, so listed equity, fixed income, private markets, is actually very stable, and we aren't really seeing a great deal of variability for any individual strategies or distribution channels. But we should note that there's quite a wide range of fees that are applied to any one of those. So depending upon the mix of products, and what we've seen over this period is a preponderance of flows tending towards the middle and lower margin products, and that's brought down the weighted average. So it's not a question of having to charge a lower fee, it's simply growth in the lower margin products. In terms of looking forward to the future, of course, it's hard to say, because that would be a question of predicting exactly which channels produce which flows. We're seeking to grow all of the channels, both the in-house direct distribution, but also our third-party accounts. And we would hope to see growth in both. and the weighted average will just be a factor of whichever one comes out on top, which is hard to predict.
Thank you, Charlie. And that sort of links into John Gilbert's question about, could you talk a little more on the two new investment strategies?
Yeah, so the Asian Opportunity Strategy is a version, as I said, of the Global Opportunities product, which we have been running successfully since 2015. So because of our experience with the Asian Environment Strategy, which we launched in 2009, that's incidentally the strategy behind what's called Green Tigers, which I saw was also a question. So good track record since 2009 with Asia Environment, or Green Tigers as BNP Paribas calls it for their fund. Good performance of Global Opportunities. So the Asian Opportunities is a blend of the two, and is being led in terms of investment management by our team in Hong Kong, which we've had in place doing research into regional stocks since 2007. The second strategy that we have got out of the gate this period has been the sustainable infrastructure orientation of one of our smart beta strategies in the US. So there's a lot of excitement at the moment about the Biden administration's $1 trillion stimulus package for infrastructure and sustainable infrastructure, which essentially is that infrastructure which is consistent with the sustainable economy. So in other words, telecoms, renewable energy, power generation, water supply, rather than airports and ports and roads. So that sort of tilt towards particular types of infrastructure is something that Impax is very knowledgeable about. And the early signs from our reprogramming of one of our smart beta funds is that that's really sort of capturing some great alpha, and investors are starting to take note. So that was the other development in the period.
And Max Smith's got a question which follows on from that, about the performance question. And he says that granted that there's different risk profiles, what has been the relative performance of the Impax share price against the standard or largest UK fund over the past 3 or 5 years? That's an easy one for you to answer. But he follows up with, similarly, I noticed that the majority of asset under management growth is from net inflows. Is there a figure at which your assets becomes unscalable? So that's a question that really is highlighting, is there a limit on what the growth which you can actually achieve, because you have been growing very, very fast recently?
Yeah, so let me take those in reverse order. So what we've been saying in our public statements recently is that in terms of US dollars, we can take the current assets under management, which is about $46 billion, up to something like $80 billion US dollars without needing a material contribution from new strategies. And at that point, according to our models anyway, we'll be sort of out of capacity, and we'll need new strategies to pick up the baton. So to the first question, if I understand it correctly, it's really asking how is Impax Asset Management Group PLC share price done against the funds that we run or the market?
Against the market, yeah.
Against the market, yeah. I'm afraid I can't give you the data.
Well, I can tell you, you've done a hell of a lot better than the rest of them, because I've been following it myself. Yeah.
Yeah, I mean, it just in very simple terms. 4 years ago, when we were just signing up the Pax acquisition, our share price was about £1, and now it's about £11 something. So I don't think the market's increased by that factor in
certainly not
4 years.
And Oscar Kaya asks, you mentioned that you still have room to expand in capacity. Does that include your competitors' increased push into the same areas, which may decrease the potential returns of all participants?
Well, the capacity increase that I just referred to, the 46 to 80 billion, that's derived from our own restrictions and not dependent in any way on what others do. least to first order. So that's taking the liquidity of the portfolios we run and making sure that it doesn't drop below a certain level. How the investments made by others might influence that calculation could be thought of in terms of what happens to pricing, and if a lot of money floods into the sector, then prices will go up. Having said that, it's quite likely that liquidity will go up as well, which would technically increase our capacity. So everything else being equal, if there's a lot more money coming into the space, then our capacity will go up, but we're going to have to work hard to navigate the pockets of exuberance that I was talking about in the answer to the previous question.
And we see you very much, Ian, as the leader of this company and as its founder, but there's always a succession issue in such companies. And is this a single superstar company, or is this a team approach?
Well, it's very much a team approach, and what we've really striven for, and I think been quite successful in doing, is avoiding the superstar culture in any part of the company. So all our investment funds have 2 portfolio managers, and we don't promote the portfolio managers as the stars of Impax. Impax is a team, it's a firm. Our distribution, client service, etc., is run by a highly capable group, leaders in North America and Europe. And so my job is really, amongst other things, just to make sure that these very talented people are working together harmoniously, that our culture is solid, that we're recruiting the right additional people, and we're developing the right profile in the market. So we do have succession plans for all key people. Of course, at the end of the day, there's one needs to acknowledge that certain jobs that we do are pretty specialized and not unique. And so if somebody did move on from a senior management role, we might have to sort of restructure somewhat. But yeah, I mean, our board is very conscious of the fact that we need to continue to sort of shape and hone our succession plans, and that's sort of right in the center of good governance. So we are doing that.
Charlie, did you want to say something? You had your hand raised. I missed your chance.
No, apologies.
And in ShareSoc, we're very keen on diversity and gender issues. Although we only have 7% of our members currently as women, but we're hoping to increase that. And so we're very interested in your gender lens strategy. Could you just tell us a little bit more about that? Is it aimed particularly at women investors?
It's aimed at companies that are run to a significant degree by women, so high percentage of boards and senior management teams that are women. So we found 400 listed companies around the world that qualify according to our thresholds, and we've created a sort of mini universe to show what if you like, the basket looks like. The fund we're running at the moment is actually a smart beta version of that, so a little bit of a skew towards those the subset of that 400 that've got high percentage of women in senior management and boards. I think it's also important to mention that Impax's main board is 40% women in terms of non-executives, 2 out of 5, and we do have a very strong equality, diversity and inclusion program. So we're now signed up to support the Diversity Project, which is a London or UK and US based diversity NGO, City Hive, which is really encouraging the development of talent, particularly from ethnic minority groups. So we are very keen as well on the ED&I topic.
Would you say you're in the top quartile or the top decile of fund managers in that respect?
I can't give you any data because I don't think it's widely available yet, but we certainly aspire to be in the top decile, yes, in terms of sort of attractiveness for women employees. I believe that our staff is now over 45% women, and we're working hard to ensure that women progress up through the ranks. So our senior management is more skewed in sort of 50-50. We do have 3 senior women at our exco level out of 12, so going in the right direction.
Well, that sounds excellent news. I think we're sort of running up against the time scale. I don't know if you would like to make any finishing comments, either Charlie or Ian.
No, look, we really appreciate the partnership with ShareSoc, and a number of the names that have been mentioned in the Q&A, people that I've definitely met in the past. So great to see you all again. Thank you for your support. Always happy to get feedback and advice and suggestions from you in the usual channels. So look forward to staying in touch.
Thank you very much, Ian and Charlie.